Today we're going to talk about payroll journal entries. Your text, this is Chapter 6. There are two payroll reports that are required by law, a payroll register and an employee's earnings records. The payroll register is completed first. Each check, you've calculated out each check, and that information from that employee's check is transferred is put onto the payroll register, and then it's transferred, posted, copied, if you will, from the payroll register onto that particular employee's earnings record. The payroll register and the employee's earnings record may be combined into one report. However, even though we've been doing this all semester, and these are required by law, they're not considered recorded as concerning our Accounting 101 as concerning GAAP. Okay? GAAP means they've been recorded into a general journal or some other type of journal and then posted to the general ledger. And this has not yet been done, even though we have all the information. And so this chapter is about that part of the payroll process. It's necessary to use two activities, as I just said, journalizing and posting. Journal lists transactions in chronological or date order, and these might go in a general journal, or it might go into a special purpose journal, such as a special payroll journal that's made up. Either way, they're going to be recorded in date order. From there, we're going to post from the journal into the general ledger, whichever accounts that we used in the transactions we have journalized. Those accounts will then be updated by posting into the ledger. Journal entries in the general journal, if you're going to use a general journal, follow a set format. You have labels that need to be across every single page, which include the date, the description, the post-reference, a debit, and a credit column. Generally, the word general journal is across the top, and there's a page number listed on top if this is a manual system. If you have a computerized system, typically you don't need a date because the computer will track between the ledger and the journal without having to have a date. If you have a manual system, a page number. If you have a manual system, you have to have that page number to track back and forth. The month is listed on the first line only. The date is listed for each transaction. Debits are listed first, credits are second and indented. The debit amounts must equal the credit amounts, and an explanation gives the details to the source documents. This is just a rehash of what you've learned in Accounting 101. Now, when we do payroll, we're going to have to do at least two journal entries. One is for the actual payroll distribution. That's the employee part, and that's going to come from the totals of the payroll register. The other one is the employer costs, which we've been talking about in class, the matching of the FICA and the doing of the unemployment taxes, food and SUDAR employer costs, and we're going to have a journal entry on those as well. The gross wages, the total of the gross wages from the payroll register is going to be an expense. Some companies may allocate this wages expense into various different department wages expense, or possibly into things like office wages, sales wages, factory wages, or things like that. So that will be an internal decision as to how it is, but regardless, gross wages is going to go into a salaries or wages type of expense account as a debit. Then we have various deductions, which are liabilities. We've taken things out of the employee's checks, but they don't belong to us, the company. They have to be sent on to whoever. So payroll taxes, such as your 941 deposits, they're made to the IRS. You have state income taxes you have to send on to the state, possibly city income taxes. You might have child support that was taken out that has to go to the child support agency. You have 401k or other pension type deductions that then have to go there. You have health insurance possibly being taken out of the employees that has to go to the health insurance company. So you have a variety of deductions, and they have to go different places, and these are all liabilities of the company. We took them out from the employee. We're holding on to them, but they don't belong to us. We owe them out. And so the company may have a variety, a separate liability account usually for each one of those types of liabilities, or sometimes they will lump things in as few liability accounts as possible, generally, especially if the company is very small. The net pay, the total net pay that was paid out in terms of checks and direct deposits and things like that, is a credit to cash. The employer cost entries show the matching of the FICA and the unemployment taxes. This comes out of the employer's pocket, and so this is an expense of the employer, and this will be called payroll tax expense. It is also due. We're not paying it on the day we calculate it. We're going to pay it next month or during our semi-weekly deposit period, or whenever it happens to be due, if it's health insurance or whatever, then we'll have to pay it at some later date. And so again, we're going to have a liability that's going to be credited. This shows a payroll register, and we're going to use these numbers as examples. And so on this payroll register, we have two employees, John and Mary. Gross wages are listed there, and they total up to $1,500. They had federal income tax taken out of $110 for the two of them, Social Security $93, Medicare $21.70, and leaving the net pay for the two checks of $1275.30. These totals from the payroll register are what we're going to use for our journal entry, the first journal entry, which is the payroll distribution or the employee part of the journal entry. We do not list a journal entry for John and then a separate journal entry for Mary. What if you had 1,000 employees? You would never get through it. Okay, so no matter how many employees there are or how many got paid that day that's on that payroll register, you're going to use the totals. We use the total gross wages of $1,500. We're going to use the total, those liability accounts, and we're going to use the total net pay, which is going to be credited to cash. So here's our general journal, page 23, and we have the date, and this is the same date it was on the payroll register, September 30th. We are debiting wages expense for $1,500. That was the gross wages on the total of the payroll register. We're crediting FIT payable for the $110, Social Security payable for the $93, Medicare payable for the $23.70, and we're crediting cash for the total net pay of $1275.30. And we have our explanation to record wages from week ending September 30th. And we made sure, of course, that our debits equal our credits. Now, here's the calculations for the employer costs for this particular payroll. We had to match the FICA, so we're going to match the $93 of Social Security and the $21.70 of Medicare. Then we had to calculate unemployment taxes, and we're going to assume that both John and Mary are under the $7,000, and that we're going to assume that the SUTA rate is 3.2% for this company. So we're going to take the whole gross wages are taxable because both employees are under the limit. So the whole $1,500 of wages is taxable wages for FUTA times 0.006 is $9. And for SUTA, the whole amount, $1,500 times 0.032 is $48. So now we have the $93, the $21.70, the $9, and the $48 added together is $171.70. This is our total employer cost that's going to come out of the employer's pocket. Now we have to make a journal entry for that. The journal entry is going to be dated the same date. Now I've got the whole month in here because I'm just showing you one journal entry, but this would have normally been in the general journal right under the previous journal entry, so typically we would have only had the 30 there. We're going to debit payroll tax expense for $171.70. We're going to credit Social Security payable for $93, credit Medicare payable for $21.70, credit FUTA payable for $9, credit SUTA payable for $48. Make sure our debits equal our credits, and we put our explanation to show employer costs for September 30th. A lot of times a company has a separate bank account for payroll checks, and this is so that the payroll department is reconciling that bank statement that belongs to the payroll checking account. Instead of some accounts payable person or someone else in the company who then has access to see all the employees and how much their check was for, we want to keep that information enclosed into the payroll department where payroll employees know the confidentiality is a very important part of their job, and they might get fired if they're not being confidential. So we would like to have a separate payroll checking account. Well, when we sell products or services from the company, the money that we get from customers is not being deposited into the payroll checking account, it's being deposited in the regular checking account. So the payroll checking account ends up having money going out, but no money coming in. So whenever we do payroll, if we have a separate payroll checking account, we need to do a third journal entry where we're going to transfer money, enough to take care of the checks, the net pay. We're going to transfer that from the regular checking account into the payroll checking account. So we make a check out from the regular checking account for however much the net pay is. Maybe we'll put a little cushion above that, and we're going to then deposit that check into the payroll checking account. Then, of course, we have to do a journal entry for that. So here's we're going to debit the payroll checking account, $1275.30, and credit cash, which is the regular checking account, for the $1275.30. Debits equal credits. Here's my explanation. To record a transfer from the regular checking account to cover the week ending of 9/30. At this point, you're typically done with journal entries from the typical regular payday. So now what do we need to do? We need to then post those journal entries to the general ledger. Posting consists of 5 steps. We have to post or copy the date onto the particular account that we're posting to. We then post or copy the debit or the credit amount, whichever it is in the journal entry. Then we calculate the running total balance, and we use our rule of thumb. Debit and debit is add, credit and credit is add, and debit and credit is subtract. We record where this information come from. This is a 4-step. Into the ledger's post-reference column. And then we go back to the journal and post where was this posted to. So that's our 5 steps of posting, and again, this is a rehash from Accounting 101. So here is an example of FIT payable, account number 221. And we had the total that was withheld from the employees was $110 on September 30th. And we had our journal entry where we had credited FIT payable for that $110. So here we're going to post that. First we post the date. Notice that the month of September is already there. These numbers in black here are just pretend numbers that I just filled in so it looks more realistic. Okay, and on the 30th we post the date. We post, second step is to post the amount. It was 110 credit. The third step is to calculate our new running total balance. Now we have to know this is FIT payable. That's a liability account. Starts with a 2. Has a credit balance. That means every number in this balance column is a credit. That's $350 credit. This new number is $110 credit. Credit and credit is add. 350 plus 110 gives us a new balance of 460. Of course, that too is a credit balance. The fourth step is to say, where did this information come from that I just posted and copied? It came from the General Journal, page 23. Finally, I go back. My fifth step is to go back to the journal entry, to that original journal entry that I made on page 23, and I post in that, yes, I posted this FIT payable of $110 credit to the account number 221. Now, of course, you would have to post all the rest of these numbers into their respective accounts. All right, let's move on to when the employer makes a deposit. And we've been talking about deposits in class. Periodically, the employer needs to deposit, needs to hand over this money that it took out of the employees and or that it owes from its own pocket. So the monthly 941 depositor has to send the FIT they took from the employees and the FICA liabilities, some of which came from the employees, some of which came from the employer's own pocket. Okay, those things all added together, they need to send by the 15th of the following month. Okay, FUTA is generally deposited to the IRS on the last day of the month following the end of the quarter. SIT depends on the state. Each state is going to have separate rules. In South Carolina, the South Carolina SIT is due to the state just like the FIT, so the 15th of the following month. SUTA is generally paid at the same time FUTA is. It's just not deposited. It's actually you pay a check with the form itself. Health insurance, union dues, child support deductions, all these other things all have their own payment rules, and you'll have to know what they all are so that you know when you have to pay this stuff. When it comes due that something needs to be paid to these various things, a check needs to be made, and that can usually come out of the regular checking account, but a check needs to be made out and sent to whatever place it needs to be sent to. Okay, so what happens now? We have to make a journal entry. What has happened? Well, the liability is reduced. Okay, if I've made a 941 deposit, I no longer owe that FIT, that FICA amounts anymore because I just paid it. So I need to reduce those liability accounts. Okay, when I reduce a liability, it means I'm going to debit that liability. The cash account, I'm writing a check out to the IRS or whoever, Okay, it's coming out of the regular checking account. Okay, so the cash account is reduced, and when we reduce an asset, it needs to be credited. Okay. The payroll accountant, even though you're not the one in charge perhaps of writing checks out of the regular checking account, you need to keep track of those general ledger accounts that relate to payroll and what's going on with them, and making sure that things are posted correctly, payments are deducted correctly, etc., and paid out at the time that they're supposed to be paid out. Otherwise, there's going to end up being penalties. Okay. Once you've decided that general ledger, all the journal entries were put in correctly and they were posted correctly, then you can use that general ledger to decide how much to deposit. Okay. For the 941 deposit due on October 15th, you're going to look at the FIT payable account, the Social Security payable account, and the Medicare payable account for anything added to those accounts during the month of September. So the total in FIT payable at the end of September, the total SS payable at the end of September, and the total Medicare payable at the end of September, those added together is what you owe on October 15th. But again, you need to first check and make sure that everything was done correctly before you just use those numbers. So here is FIT payable account number 221 again. Notice that at the beginning of September, means the end of August, we owed $420 to the IRS as part of our 941 deposit. On September 15th, we paid that $420 along with the Social Security and Medicare as part of our 941 deposit. So now we would have reduced that by debiting the FIT payable account for that $420. We no longer owe it. Our previous balance was $520 credit. This is a $420 debit. Debit and credit is subtract. $520 minus $420. We now have a $100 balance. Then we had some more payroll information go in there that built us up. By the time we added this last payroll on the 30th, we had $460 credit balance that we owed to the IRS, which represents all of our September stuff that we owe out. So I can use this number, if I've double checked all this stuff, I can use this number to say, well, this is how much FIT needs to go in my October 15th deposit. So now here, if we've made the FIT, the Social Security, and the Medicare, we would have done the same thing in those accounts, gone and look and see what do I owe at the end of September. And so here we've debited all three of those liabilities, and we credit cash for the total amount. We're going to write a check to the IRS for $1430, or actually we're going to electronically transfer $1430 from the checking account directly to the IRS electronically. So, and here is our explanation to record employer 941 deposit for September payroll. Then, of course, these accounts need to be posted. And here's where we posted to the FIT payable account, copy the date, copy the amount, 460 debit, okay? We previously had 560 credit. Credit and debit means subtract. 560 minus 460 leaves us $100 balance at the end of October 15th. All right, so that takes care of the day-to-day regular stuff. At the end of the month, we might have a wage accrual, and at the end of the fiscal year, because of the matching principle in accounting, we have some other accruals that might happen, and so we're going to talk about those journal entries here. Whenever we get to the end of the accounting period, we have to look and see, because it doesn't always coincide with the day of payday. So if payday is on Friday, but the end of the month is on Wednesday, then it's not going to be till Friday that we would want to debit wages expense. And by that time, we're into the next month, and the whole week's worth of wages expense is shown as being next month wages. Whereas the matching principle says I need to break that apart into how much wages expense belong to this month, how much wages expense belongs to next month. Now, adjusting entries, which is what we're talking about here, adjusting entries are just an estimate. Now, don't have to be exact. So on Wednesday, when I'm doing the adjusting entry, which is the last day of the month, I don't know exactly how much gross wage is going to be. I don't have a payroll register yet because I don't have everybody's timesheets in yet and everything else. And there might be somebody gets overtime, all that kind of stuff. I'm not going to worry about that. I'm just going to go back to last week's payroll register and use last week's gross wages as an estimate of this week's gross wages. And I'm just going to debit wages expense and credit wages payable whenever I do that kind of an entry. Here they're also talking about if wages are calculated every Wednesday but not paid till Friday, then on Wednesday when we calculated and we made the payroll register, if that's what we're doing, then we would credit wages payable on Wednesday. Then on Friday, when the wages are actually paid, we would debit wages payable and credit cash. So this is if we're actually calculating wages and filling out our payroll register on Wednesday. And then this is where we're talking about if we are at the end of the month and we're doing an adjusting entry, where we're going to debit wages expense and credit wages payable. Typically in this kind of situation, the very next day we do a reversing entry where we debit wages payable and credit wages expense for the same amount that we did on the adjusting entry. That way the payroll department can just go forward on Friday and do their regular journal entry without worrying about what happened in the general journal back on Wednesday. So here is an example in the middle of this page. If last week's gross wages were $1,500 and there was 3 working days, Monday, Tuesday, and Wednesday, we're at the end of September, then we would take the $1,500 estimated gross wages from last week and multiply it by 3, divide by 5 working days, and that equals $900. We would debit wages expense and credit wages payable for $900. Usually at the end of the fiscal year, we have some serious major adjusting entries that we don't maybe do every month. We just wait till the end of the year. And so some of the ones that deal with payroll of these types of entries might be vacation pay or other things that vest. Vacation pay typically vests, means that the employee has the right to be paid these days. So if an employee gets 2 weeks of paid vacation and they didn't use it all year and they quit, we would still have to pay them for those 2 weeks of vacation. When they quit, we would have to hand them a check for those 2 weeks of paid vacation that they didn't take. So If sick days are like that as well, if they vest, then we would also do the same process for them. Oftentimes at a workplace, sick days do not vest. You're told you get X number of sick days, but if you don't use them, you're not going to get paid for them. Okay? Personal days may vest or they may not vest. So you just have to know in your company which types of days vest, and those are the ones we have to go through each employee and figure out how much vacation pay has vested to that employee by the end of the fiscal year that that employee didn't use, how many personal days, how many sick days that they vest that the employee earned but did not yet use. Okay, so here's an example. If two employees each earn 10 days of vacation, there would be two normal weeks of vacation, okay, but they only took 6 of those days each, and they're going to take the rest next year. So here we are at the end of the fiscal year, and we have 2 employees who each took only 6 of their 10 days. And those employees each earn an average of $100 a day. Remember, adjusting entries are just estimates, so we don't have to get particular here. Okay? So 2 employees times the 4 days that they still haven't received yet that we owe to them times $100 a day is $800. Okay? So we owe out $800 more of vacation pay that we're going to have to pay out next year sometime. So we're going to debit vacation benefit expense and credit vacation benefits payable. We owe that $800 out. Now, some companies might not have a vacation benefits expense, in which case you would just put that into regular wages expense.